In the next 90 days, the largest wealth transfer in modern American history is going to begin, and 95% of retail investors are positioned on the wrong side of it. I am not exaggerating. I am not selling you anything. The data is already on the tape, and once I show you what is happening underneath this market right now, you are not going to be able to unseen it. If you own an S&P 500 index fund, what I'm about to say in the next 60 seconds will either save you from the biggest mistake of your investing life, or it will hand you the single greatest wealth opportunity this decade is going to produce. There is no middle option, not this time. So before you scroll, before you click away, before you tell yourself you have heard this before, give me 10 minutes. Because by the end of this video, you are going to understand exactly where institutional money is rotating, the three sectors absorbing it, and the names quietly compounding before the headlines catch up. History is about to be made. Let me show you which side to stand on. 40%. That is how much of the entire S&P 500 right now is controlled by just 10 companies. Not 100, not 50, 10. The most concentrated American stock market reading in over 50 years. And here is what nobody on financial television is telling you. The same machine that pumped that money in is about to start pulling it out, and it is already happening underneath the surface of this market right now, in April 2026. If you are holding an S&P 500 index fund, and you have not heard this yet, you are about to lose money you do not need to lose. And if you understand what I'm about to show you in the next 10 minutes, you could be standing in front of the biggest wealth opportunity this decade will produce. I am going to give you the three sectors institutional capital is rotating into, the specific names sitting at the center of that rotation, and the discipline you need to actually capture it instead of watching from the sidelines. Stay with me. This one matters. Let me put something on the table that will make a lot of you uncomfortable. If you own an S&P 500 index fund right now, you do not own a diversified portfolio. You own a leveraged bet on a handful of artificial intelligence and mega-cap technology names dressed up in the costume of diversification. Research from RBC Wealth Management published this January confirms that the top 10 holdings closed 2025 at roughly 41% of the index, more than double their weight from a decade earlier. Goldman Sachs analysis suggests the historical relationship between this level of concentration and forward 10-year returns points to something close to negative 5% annualized. Read that again, negative. Why is that happening? Because passive investing is not actually passive. Every dollar that flows into an S&P 500 ETF gets routed mechanically toward the largest names. Bigger company, bigger weight, bigger automatic buy. It is a feedback loop, and feedback loops work brilliantly on the way up and brutally on the way down. Now layer on the macro environment, because this is where the trap closes. The federal funds rate is sitting at 3.5 to 3.75%, held there by the Federal Reserve at their March meeting. Inflation is still running above the Fed's 2% target. Jerome Powell's term ends next month, and the entire monetary regime is about to change leadership at the worst possible moment. Then there is the energy shock. The Iran war that broke out at the end of February sent Brent crude as high as $120 a barrel in early March. The International Energy Agency called it the largest oil supply disruption in the history of the oil market. Even after the April ceasefire, traffic through the Strait of Hormuz is still running at a fraction of pre-war levels, and analysts at major banks now expect Brent to anchor in the $80 to $90 range, not return to where it was. So here is the macro reality you are actually invested in. Sticky inflation, a Fed that cannot cut aggressively, an energy crisis that just rewrote the global supply map, and 40% of your index sitting in companies whose valuations were built for a world of zero interest rates and cheap globalization that does not exist anymore. That is the trap. And the people who already understand it are quietly moving their capital somewhere else. Let me show you where. Here is the thing about money. It does not vanish. It rotates. In 2022, when the S&P fell, energy names returned 20 to 50%. The capital did not exit the market. It moved, and the investors who saw the rotation in advance compounded while index holders bled. The same thing is happening right now, only the destinations are different, and the catalysts are bigger. I want to walk you through three structural forces that are pulling capital out of crowded mega-cap technology and into sectors most retail investors are not even watching. Force number one, energy infrastructure, not energy producers. When oil spikes, retail investors pile into oil stocks. That trade has already happened. The smarter capital is going to the picks and shovels names. The companies that build the LNG terminals, the gas turbines, the compressor trains, the power systems that actually move energy from where it is produced to where it is consumed. Look at Baker Hughes, ticker BKR. Their first quarter 2026 results landed last week. Industrial and energy technology orders hit a record $4.9 billion in a single quarter. Their total backlog now sits at $36.1 billion, with the IET segment alone at $33.1 billion, an all-time record. Their CEO publicly raised the long-term target, saying he is increasingly confident those orders will exceed $40 billion by 2028. The stock jumped almost 7% on the news to a new 52-week high. That is not a trade. That is institutional accumulation showing up in the price. And here is the kicker. A huge piece of that backlog is power systems for AI data centers. Baker Hughes is now selling turbines and power packages directly to hyperscales because the grid cannot keep up with what artificial intelligence needs to run. They are simultaneously a war beneficiary, an LNG beneficiary, and an AI beneficiary. 3 structural tailwinds, 1 company. Force number 2, uranium and nuclear. For 30 years, uranium was a dead asset class. Then artificial intelligence happened. U.S. data center electricity demand is projected to grow from 176 terawatt-hours to as much as 580 terawatt-hours by 2028. Microsoft is restarting 3 Mile Island. Meta announced a 1.2 gigawatt nuclear campus in Ohio with Oklo. Amazon Web Services has signed multiple nuclear offtake deals. Spot uranium broke $100 a pound in January for the first time in 2 years, before settling near $89. Enriched uranium hit $190 per separative work unit, up from $56 just 3 years ago. Surveys of institutional investors point to a $100 to $120 range through the rest of this year, with upside scenarios as high as $135 if supply does not respond. And supply is not responding. Kazatomprom, the world's largest producer, cut 2026 guidance by 10%. Russia, which controls 44% of global enrichment capacity, is locked out of U.S. imports. The Department of Energy has now committed $2.7 billion over the next decade to expand domestic uranium enrichment. Uranium was added to the official U.S. critical minerals list in 2025. This is no longer a commodity story. This is a national security policy directive funded by the federal government with multi-year visibility. The Global X-Uranium ETF, ticker URA, returned 120% over the past year. Cameco, ticker CCJ, sits as its largest holding. NextGen Energy, Uranium Energy Corp., and the smaller developers behind them all sit on a supply curve that physically cannot expand for 5 to 7 years. Force number 3, critical minerals and rare earths. This is the one almost nobody is paying attention to, which is exactly why it matters. In February, Secretary Rubio hosted the 2026 Critical Minerals Ministerial. 54 countries signed on. The U.S. Export-Import Bank has now issued $14.8 billion in letters of interest for critical mineral projects. Project Vault, a $10 billion U.S. strategic critical minerals reserve, is being built right now. There is $1.3 billion going into Reko Diq copper and gold in Pakistan. There is $565 million for rare earth extraction in Brazil. There is $400 million for lithium in Arkansas. There is $455 million for domestic rare earth processing. This is government-mandated, multi-year non-cyclical demand. It does not care about recessions. It does not care about Fed policy. It is being driven by the simple geopolitical fact that the United States cannot allow China to control the supply chain for the materials that build advanced weapon systems, electric vehicles, AI chips, and the power grid itself. Resolution Copper alone, the Rio Tinto project in Arizona, could supply roughly 25% of U.S. copper demand once it comes online. Lithium from Thacker Pass in Nevada is breaking ground. Companies positioned in domestic lithium, rare earth processing, and copper development are sitting at the intersection of policy capital, AI demand, and electrification demand all at once. Now I need to slow down and tell you something more important than any ticker. Identifying the rotation is the easy part. Capturing it is what separates the people who actually build wealth from the people who watch wealth get built without them. I have seen this movie too many times. An investor sees a thesis, gets excited, dumps half their portfolio into one name, and then the first 10% drawdown shakes them out at the worst possible moment. Even gold, in the middle of its greatest bull run in the 1970s, dropped 47% between 1974 and 1976. Multi-year structural moves do not happen in straight lines. They never have. So here is the framework I use, and I am giving it to you for free because I genuinely want you to win this one. First, position sizing. Never put more into a single thesis than you can lose without being forced to sell. Conviction is not a strategy. Survival is. Second, entry on confirmation, not anticipation. Institutions do not catch falling knives. They buy when a stock breaks above its consolidation range with volume that is meaningfully above the 20-day average. That breakout is the evidence that buyers are stronger than sellers at that price. Without it, you are guessing. Third, layered entries. You do not deploy your full position on day one. You scale in. A third on the breakout, a third on a successful retest, a third on continuation. That way, if you are wrong small. If you are right big. And fourth, time horizon. The energy infrastructure cycle has years of capital expenditure ahead of it. The uranium supply deficit is a 5 to 7 year story. The critical minerals build-out is a decade-long policy program. If you are checking these positions every day, you are going to drive yourself out of them. Set them, size them, watch them quarterly, and let the structural force do the work. Let me close with the part that actually matters. The reason I called this video the last big wealth opportunity for a decade is not clickbait. It is math. The S&P 500 has now spent 2 consecutive years compounding at over 14% off the back of 7 companies. That compression cannot continue indefinitely. When it unwinds, and history says it always does, the capital is not going to evaporate. It is going to find the sectors with structural earnings tailwinds: energy infrastructure, nuclear and uranium, critical minerals, domestic manufacturing. The names that benefit from a world where energy is scarce, supply chains are political, and AI consumes more electricity than entire countries. The investors who position before that becomes obvious are the ones who look back at 2026 the way people now look back at 2009 or 2020. The ones who waited until it was on CNBC every morning will be buying the top. Here's what I want from you right now, and I am going to be direct. If this video gave you even one idea that changes how you think about your portfolio, hit the subscribe button. I am putting out one of these every week, and the next one is going to break down the 3 specific small cap names inside the critical mineral supply chain that I think have the most asymmetric setup of anything I am watching. You will not want to miss it. Drop me a comment below. I read every single one. Tell me which of the 3 sectors you are most interested in: energy infrastructure, uranium, or critical minerals. The comment with the most upvotes is getting a full deep dive video next month. And if you have been holding only an S&P 500 index fund and this conversation made you uncomfortable, that discomfort is information. Sit with it. Do your own research, but do not pretend you did not see this. History is about to be made. The only question is which side of it you are standing on. I will see you in the next one.